In this video here, we're doing an analysis on Occidental Petroleum Corporation, OXY. This company was brought to my attention by a buddy of mine, Mark, so thank you for the recommendation, because Warren Buffett has been purchasing shares of this company over the last 2 quarters. Most recently, the one that's reported at the time of recording this video, August 15th, he reported, I think, adding I think 16% more or something. I don't know, some huge number to his stake of what he's currently has. So this company here deals with a lot of natural gas and oil and chlorine and a lot of other manufacturing, and deals with where the United States, Middle East, and Africa and Latin America. Huge pinpoints for a lot of oil and gas production. Especially, I like that they're dealing with Africa, because Africa, they are primed to actually do what China has done in the 1980s, but probably double the speed once they had their workforce together. But this company has been, its headquarters are in Houston, Texas. It was founded in 1920, so it's not a new company, but they deal with a lot of different facets in the oil and gas and energy sector. And Warren Buffett loves this company based off his buying. So let's investigate what this company is all about by the numbers. So taking a look at OXY, our PE 12 months is currently sitting at 5.69, but on average it's sitting at 20.82, so fairly low. Our EPS is up over our 5-year average. Our ROE is incredibly high, and it's up over our 5-year average. Profit margin is up as well. So first 4 categories off the top here, enjoying what I'm seeing here. We're up over our 5-year averages, which is great. Revenue is sitting at $33.73 billion, net income $10.6 billion, free cash flow at $11.55 billion to the trailing 12 months, and our average free cash flow is $2.7 billion. Very interesting. We pay a very small dividend at 0.44%, and that comes out to be $839 million paid out, and that works out to be, well, easily covered by our average free cash flow. But I'm astounded by our trailing 12 months free cash flow right now, sitting at $11.55 billion. Wow. Return on invested capital is also high, sitting at 19.42 compared to 5.09. A decent Piotrowski score sitting at 7, but a questionable Almanzi score sitting at 1.73. Not bad. They've been making some improvements. I am enjoying that. 52-week range of this company has seen a low of 21 and a high of 74. Not bad. Now, jumping into our financial valuations category, now this segment of my software here looks at the cash flow statements, the income statements, and the balance sheets, and based off my parameters that I've set up, grades this company out of 10. We are ranking this company a 5 out of 10, so a pretty mediocre score, but let's see what that's about. What are they doing right, and what are they doing wrong? It seems to me that based off what I've seen in the company metrics is that they've had a few negative numbers in their past, but now they're starting to crush it. So with our current ratio here being the first I guess X and 0 that we're getting here is 1.07. It's not the worst, it's not the best. We want to see this number over 1.5. 1.07 just means to me that they have enough assets to cover their liabilities. We want that extra margin of safety in case things turn out for the worst. They have that buffer zone to cover those liabilities. Our ROE average is negative 8.93. Not that great, but a trailing 12 months, as we expressed, is sitting at 46.10. That's incredibly high. But our 5-year average is not that high. So it seems like this company, as I said, is on this turning point. Our debt to equity, though, incredibly high, folks. Take a look at this. 147%, where we want to see this number beneath 50%. We don't have that. So that means that they're leveraging their capital through taking on debt and not by building equity. So that's something to keep in the back of our heads, as well as they are slightly diluting us at 1.77% increase in shares over the last 5 years. Not the worst, not the best, but we want to see this number ideally decreasing, as well as our ROIC average being 5% and not our 10% or higher. I could live with that, considering our trailing 12 months sitting at 19.42%. So this is why I like to see, folks, what are they currently doing? What have they been, and this is why I do this cross-examination. What has the company currently been doing? What have they done? And what's the average? That way we can see the full picture 360 degrees is what we're trying to see here, folks. So on the plus side, what they are doing right, though, our 5-year PE average is sitting at 20.82. That's beneath our 22.5 mark that we want to see, which is great. We'd love to see a low PE ratio, as well as our EPS growth is up by incredible amounts, as well as our net income is up, our free cash flow is up, and our revenue growth is up. The trifecta, I love seeing that. If there's one thing that gets me excited about a company, is seeing the trifecta all in green. The net income, the free cash flow, and the revenue growth. That means they're doing a lot of things right in terms of making that moolah. So free cash flow, look at that. $7.66 billion 2021. And look at that, guys. A negative year were 2015, but most of the years have been pretty positive. Gotta say, fairly impressed. Looking at the income statement, let's get the full story of our revenue. And it's been slowly. This is our quarter. Let's go to annual base. Let's see what we got here. Revenue. And it's been slowly building up. It's been pretty inconsistent, I gotta say. Some drops, but mostly positive over the last little bit. Looks like they had a little bit of a soft reset here, because they were pretty high in 2014, then dropped a little bit, and now been climbing back up. Not bad. Cash flow, let's go to net income. Yeah, some negative numbers, but overall positive now in 2021 output. 2020 been bouncing a little bit back and forth, but overall they've been building this company back up. So I'm trying to see what Warren Buffett's seeing. This is just the start of the due diligence, but they deal with the United States, Middle East, Africa, and Latin America. Heavy hitters in the energy sector. So some big names in there. We'll do a price analysis of this business, folks, and we'll run the numbers through, and we'll see what we should be paying for Oxy today. So I'm gonna fill out these lovely boxes here, folks. So we'll touch base about that in a quick second. So stand by for that. Like, oh my god, I can't speak today at all. So folks, before we jump into the last section of the video here, if you're enjoying the video, hit that like button, hit the subscribe button, and for this software here that I have in front of me, it's going to be available to you, my viewers and subscribers, working diligently to get this out to you. It's a process when you're a one-man army. Let me tell you, it's a mission. So jumping back into the video here, here's what I did. With our revenue growth, I had to stay with some conservative numbers. That's why I did 10, 12, and 14% based off our 5-year numbers that I've shown here. 10, maybe hovering around the 10-year number may have been, I feel like it's a little bit too conservative considering the market cap of this company, but it's still low. It's a $61 billion market cap. The profit margin, I'm going based off our 1-year average here. Now, I don't like doing that because that means I'm kind of speculating, but based off what we have here, our profit margin, being 31%, I'm gonna go 7, 8, and 8.5 based off of what we're showcasing over here, folks. The free cash flow margin, I'm going based off our 5-year numbers and 10-year numbers. So I did 7, 8, and 9. But price to free cash flow being at 5.22 is extremely low. So I'm gonna hover around those numbers. So that's why I did 4, 5, and 6. Same thing with a PE ratio, 4, 5, and 6. Calculate that with a 13% desired return. We're going to figure out what the average price comes out to be for this company. But extremely low numbers. I feel like I should have gone higher on these to give myself some buffer. But here's the thing, folks. Take a look at this. I'm being super conservative, but look at that. Average calculation comes out to be $44.46. For a current price is $64. Now it checks out on the DCF. On the moderate category and aggressive, 77 and 105. Now I could up these, and let's say I brought it up to 15. Let's say I brought this up to 16, and I brought this up to 17. Where does that take us? Because I did 10, 12, and 14% revenue growth, but it very well could do more. This thing got butchered in March, as soon as the pandemic hit. But I am very curious to see, because Warren Buffett's been buying a lot of this company, so I'm really trying to see what does he see. And our DCFs hit all across the board. This is At 16% revenue growth, we're pretty much almost at that fair value, if you believe that. Aggressive average checks out at $82. But all of our DCF, these low revenue growth numbers, all check out. $81, $114, and $141. So there's definitely some more research to be done on Oxy. Could this be the next Exxon Mobil? Could this be something like because he has been buying a lot of Chevron. He's been doubling down on his bets on Chevron. They've been upping their free cash flow, the trifecta of their revenue growth, their net income, and as I said, free cash flow has been pretty solid. He may as well just been very early, and he sees the potential for this business. Listen, he is coming from the school of seeing companies like Exxon and Chevron pretty much just boom up. This is where the research starts to happen, right? You got to dig deep and see, okay, what is this company doing that puts them at an edge over Exxon, over Chevron? What are they doing to separate themselves? The market cap for a company like this and the cash flow that they're bringing in, this is probably what's attracting him to this business. But that is my opinion, folks. What are your opinions on Oxy? Are you watching this company? Are you invested in it? Write it down in the comment section down below, as well as the company you want to see evaluated. This may be a huge buy, but you know what? You got to understand the business first and foremost. For me, I understand what they do. I understand how they make money. I'm just, the one thing I want to try to wrap my head around is how involved with the Middle East and Africa and Latin America. That's what I want to know. I want to know, apart from the oil and gas, but there are other chemical manufacturing plants like with the chlorine businesses and those segments. That is what I have to get my head and wrap around that. And there's just, and obviously the team and what they're planning to do going forward as we go into, let's say, a more greener source of energy with natural gas and so on and so forth. But if you want to see a company and analyzed, write it down in the comment section down below. Write down your thoughts about this analysis. I would love to hear your opinions. Anyways, folks, that's the video. Thank you so much for watching. I'd love to hear your feedback, and I will see you in the next one.